everybody. It's Larry Kotlikoff with Economics Matters. I'm delighted to have Mark. Mark, you got to pronounce your last name so I don't screw it up.
It's
Annese,
Annese.
right?
Yeah, yeah.
Annese, okay. No, not too bad. And an old friend, Dan McGrath. And they have an interesting company. It's called IRMAA Certified Planners. And they have a website, IRMAA Certified Planners.com, IRMA, IRMAA, so IRMAA planners, certifiedplanners.com, one word. And IRMA, if you're not getting Medicare, you will learn all about IRMA when you start getting Medicare, probably at age 65, unless you're working beyond 65 and still covered by an employer with enough employees so that you're not really forced to take Medicare. If you don't take it, you will get hit with a much higher level of IRMA, a penalty that's going to be permanent later on. So it's very important to get this right. But IRMA stands for, references the progressive Medicare premium formula. And so Medicare calls this a premium, but anybody looking at this would know that you don't get any more Medicare benefits if you pay higher premiums. So all it is a dressed up name for another tax that we're facing. And it's a very kind of complicated tax in the sense that what you pay in your premium in this tax depends on the level of your modified adjusted gross income 2 years earlier. So here you are at 63. If you took, for example, an IRA withdrawal, you're going to kick up your modified adjusted gross income at age 63, and then 2 years later you're going to have a higher premium. So it's kind of a complicated timing problem here, and you can earn an extra dollar of a modified adjusted gross income 2 years earlier, and all of a sudden be hit with a 800 or so higher IRMA premium 2 years later with no knowledge of it, unless you were familiar with this software tool that Mark and Dan here have developed. So I'm going to have Mark and Dan give us a quick background on their own bios and how they got into setting up this company, and then do a very quick demo and talk to us about everything they know about this problem, because they've set up a company to help us with this. Take it away,
Sure.
Mark.
Do you want to take it?
You want me to start off since you're going to be doing the demo?
Yeah.
Quick background, Dan McGrath, IRMAA Certified Planner, just happened to be one of the authors of the content that you'll be reading if you want to get certified within the subject of IRMA. As Larry pointed out, known him for years, dating back to the early 2000s. Between that time, been in the financial industry for over 25 years. Found this hole inside of retirement planning known as Medicare, just through personal issues with my family, have it be my mother, my aunts, uncles, grandparents. Noticed that when it comes to planning for healthcare, planning for Medicare, there's a lot of holes in a lot of the financial planning software. So we just tried to build a system that educated and also showed what those tools are. In that time, I've written a couple books. One happens to be What You Don't Know About Retirement Will Hurt You. And I also publish on an annually basis, The Guide to Medicare. That's a little bit of my background, and I'll kick it over to Mark.
So I'm Mark Annese. I'm also co-founder of IRMAA Certified Planner, as well as Healthcare Retirement Planner. IRMAA Certified Planner is a designation that has been listed by FINRA as the only IRMAA certified designation. And the Healthcare Retirement Planner is the tool that we use. My background, I've been doing this with Dan for the better part of 8 years. So we have quite a bit of background on how this works with Medicare and Social Security and people's retirements.
Cool. So Dan, you want to take it away and tell us about what you guys actually deliver and what the tool is providing advice both to households, so households can buy the tool, but also financial advisors who can use it with their clients, right?
Well, that is the goal. The goal is to educate the financial professional. When I started this years ago, when we first met, we were trying to just bring software to the financial industry on how to plan effectively for healthcare. What we found out is if a financial professional doesn't understand the subject, regardless of what the software does, if they don't understand it, it's not going to help them, nor is it going to help their end client. So what we wanted to do is be able to educate them on the subject. That's why we created IRMAA Certified Planner. Under current regulations from the federal government, we can't actually certify anyone on Medicare because it's a government agency. They actually have their own certification process through the Ship and Shine programs. But with IRMAA, that happens to be a subject inside of Medicare, we can actually educate financial professionals on the subject because, as you pointed out, IRMAA is simply a tax. It's one of those taxes that people are going to get hit in retirement, and as Mark is going to show you in the software, it's a larger tax than anyone wants to plan for. And then when you actually look at some of the information that the federal government is talking about in terms of IRMAA, these surcharges are going to more than double over the next 5 to 7 years. The federal government has figured out a way to generate revenue. The way to generate revenue just happens to be through Medicare, through this tax. So all we're trying to do with IRMAA Certified Planner is educate financial professionals on the subject of healthcare by using IRMAA, giving them the ins and outs when they start it, meaning when does the federal government start looking at people's income, who actually falls into the trap, how to get out of IRMAA, how to avoid it completely, how to appeal it. We're trying to just educate as many people as humanly possible so people can enjoy their retirements and not have to deal with yet another tax.
And when you say avoid it entirely, how I mean, you could avoid it by not being on Medicare, right?
Yes, always have your spouse work as long as humanly possible on a job that provides health benefits. You don't want to work for as long as possible. Make sure someone else does. There are, believe it or not, there are ways when we start talking about what they look at income. Income is basically your adjusted gross income plus any tax exempt interest. So it's MAGI, modified adjusted gross income. You can avoid it by using Roth accounts. We're very, very big on using Roths, using Roth conversions. Life insurance works very well. Same with certain non-qualified annuities. We try to have people look at 401h plans for small business owners, if they happen to be out there listening to your show, your podcast, as well as looking, believe it or not, reverse mortgages or home equity. Those are the ways to avoid IRMAA. We can get you out of it, but for the way the traditional savings has been done over the past 30, 40 years, yeah, it's going to be an issue for many, many, many people. So now we're just trying to educate them, plan for it, make sure that they can, what's the word I'm looking for? They can take
Minimize.
they can take the payment, they can afford it, whatever it may be. So that's our goal.
Yeah. And whether or not you can absolutely get end up with no IRMAA tax through time, which is again the Medicare premium tax, let alone a penalty for having started Medicare too late, because if you don't otherwise have coverage from a employer with, what is it, 10 or more employees?
20 more, yeah, credible insurance is 20 more employees.
20 or more employees. So let's say I'm 65, turned 65, and I'm working for somebody who has 10 employees and they've got health insurance. I have to sign up for Medicare Part B.
Yes.
And start paying the Medicare Part B Premium, which is called the IRMAA formula is determining how big that premium is.
Right.
And if I just go along and let's say 3 years later, I turn around and say, well, I've now lost my job or I've retired and I'm now going to apply for Medicare. Well, they're going to say, well, you were not adequately covered for the last 3 years because you didn't work for a large employer, even though
yes,
your 10 employer had was doing really well. Okay. So here you are, and now you're going to face a premium, which is how much higher would it be at
So
age?
so for that, it's a percentage. It's a 10% penalty for every year you miss for Part B, and then it's a 1% penalty for every month you miss for Part D. Now, in the case, I'm not saying this, I'm going to say this on a side note, that this is not always the case. But what you can do, if you can prove that you being, or the small business owner that has less than 20 employees, if you can prove that you not being on their health plan is detrimental to the other employees, that has been a case to actually waive the late enrollment penalties.
I see. Okay.
I'm not saying it'll work 100% of the time.
Mhm.
It's that
Right.
line, it's guaranteed to work 60% of the time, 100% of the time.
I got it. Okay. So here you are 3 years later, and you've got a 30% higher IRMAA premium, which is how much is a typical IRMAA premium, or let's say a high income IRMAA premium over the course of the year? Would that be like $1,500, $2,000?
Currently, right now, it's wow.
Well, it's 164 for Part B,
Yes.
and that's under
Per month, right?
$97,000 of
So it's-
MAGI.
Yeah, so you're paying an
Per month.
extra $70-$80 a month for the first
Yeah.
bracket. And then from there, you're paying an extra, depending what bracket you're in, you're paying anywhere between 70 to an extra $420 a month. The issue isn't so much what it is today. The issue is what it's going to be in the future. So if we take a look at what the federal government's telling us about Medicare Part B, we know that that premium is going to inflate by about 6.4% over the next 8 years. If it does not inflate at that rate, what we do know is that Medicare becomes insolvent faster. So we know that it has to inflate at a roughly 6.4%. So we know that the surcharges, because of this inflation rate, they're going to jump from, let's say, $240 for Part B, so an extra $70. It's going to jump all the way to $399. And then if you look at the highest bracket, you're looking at a roughly $1,000 a month. So you're going to be paying more and more as time goes on.
It sounds like if you waited 3 years, you could end up, my quick calculation is that your premium, by just waiting, not knowing that you should have started earlier, your premium 10 years out might be $10,000 a year higher for the rest of your life.
Yes.
That's not a crazy, and in today's dollars. So this is a big, big deal to get this straight. Do you want to do a quick tour of your software so people can see what they can, play with on your site?
Let me jump on this. Where is that? There we go. Can everybody see this?
Yeah.
All right, great. So when we talk about modeling, there's different pieces you have to worry about when you're modeling. There's the actual base premiums. Then you have what your income is going to be. Then you have to sprinkle in a little bit of your inflation rates along with your growth rates on your income. So what we typically do is we start with looking at what your base scenario would be. And that would be one of these three scenarios. So we always say start with your base scenario, and then you have two other ones where you can do your what if scenarios. So when we hit that, it's very simple. You're going to start off with your residency during retirement. And we're going to be in Massachusetts, we're all here currently. But we're allowed to change that because if someone was to retire to a different state, your Part B changes based on your gender, your age, and your location where you reside during retirement. So that allows you to do a little bit of a differential. But then we come down to where the rubber really hits the road, and that is going to be your income. So as Dan had mentioned before, you have two different types of income. Basically, it's two buckets. One bucket that Medicare and Social Security use to determine IRMAA, and one bucket that does not. So we're going to start by just saying this person has Social Security. They're going to get about $3,200 in Social Security per month with a COLA of 2%. 2% is current what the current COLA is. And your 401k, let's start with kind of a $750,000 401k at retirement. So that's going to be the balance at retirement. I'm going to put a rate of return of 6%. The age to begin withdrawal, we're just going to have it match to Social Security, which is 65. And we're going to do a monthly of $1,000. So when you look at something like a 401k, which, you know, quite a few people have for their retirement plans, you're going to hit your RMDs right now this year. It's at 72, and then it's going to keep going up over the next couple of years to 75. But as soon as you hit those RMDs, which are your required minimum distributions, that could also affect the amount of income you're required to take out per year, and that actually could impact going higher into those Medicare IRMAA brackets. So this software actually calculates your RMDs for you. Right now, it's starting at 72. One piece we look at is how much money do you want to make in retirement? And this is after taxes and everything else, and allows for a growth rate. So as you know, everything inflates. We also need to have more money to make our living throughout our retirement. Finally, we have our two pieces of Medicare. We have a Medicare Part B, which is a base of 164, and we have two choices here for your inflation. We have your projected inflation and your average historical. So we're going to go at average historical simply because that's the real true number. The projected is just based on what they think is going to happen. We like to look at what has already happened. And then you have the ability to choose Part B or not. When we're dealing with anybody, we tend to like to tell them to actually take Part D out of their Social Security check. Reason being, something happens down the road during retirement, you forget to make a payment in your Part D, you could get dropped and you may not be able to get back on. So it's nice to probably have that taken out of your Social Security check, automated, and make things a little bit easier for you. So that also has your two different inflation rates, which you can choose. And that's all we need to run this. So we're going to start by just hitting report.
One question before you run it is, you said that the Medicare Part. Oh, you ran it too late. Okay.
Go ahead.
Show it. All right. My question is, you said that the Medicare premium is state dependent, but I've not seen any for Part B or D.
No,
D.
Part D is state dependent, yes.
As in David.
Part B is not.
Okay. Part B. Okay, got it. And
so
Part D, there's lots of different Part D plans, right?
Correct.
So isn't it's state dependent, but it's also dependent on what plan you choose within the state, right?
Correct. And Dan, you have a little bit more information on that.
On the Part D plans, yes. So, and it's timely because October 15th open enrollment's coming up. So currently in 2024, for each state, there's roughly anywhere between 19 to 25 different plans, Part D plans that people can choose from. Part D is basically administered or run by private health insurers, and the federal government oversees, or the Centers for Medicare and Medicaid Services oversees what those plans are. So the plans, what we're just doing is using state averages. The reason being is when looking at historically how plans are created each year, new plans come on, old plans get dropped. So if we look at from 2007 to 2024, when looking at the states, individual states, roughly 3 to 4 plans have remained in existence. There's always, as I said, always plans dropping, always plans coming on board, new plans. So we just look at state averages. Give you an example, the state of California, Florida, Colorado are far more expensive for an average plan than, let's say, Vermont, North Dakota, Virginia. Those happen to be some of the cheapest places to live. And the premiums are always fluctuating, but they grow at a historically, they've been growing at about a 6 to 7% rate of inflation.
Got it. Okay, so tell us about your dashboard here.
So when you look at quickly, this particular individual, You see the flag right on the top left here, the IRMAA reached. That means this individual, based on the income that they have, is going to reach IRMAA. Their projected cost for base and surcharges is at about $1 million. And the total federal taxes they're going to be paying is going to be approximately $513,000. That's before, itemized deductions and stuff like that. It's just the forecast of that. Then over to the right, you have 4 graphs. The first graph is your total income. You can see that the graph shows kind of going up and down, these little jagged edges here. The graph below it are your Medicare costs. So if you look, each one of these bumps here correspond to Medicare costs bumping up. And that is where you see this particular person is hitting IRMAA brackets. So IRMAA brackets jump up, their income goes down. On the top right, we have your total taxable income. And this is actually where kind of the rubber hits the road with what the government wants to look at in terms of determining your IRMAA. You see that's constantly going up, and that's the one that's traversing those IRMAA brackets. And finally, the one below it is your Social Security check. So because the way that IRMAA works, Medicare and IRMAA works, is that is deducted directly from your Social Security check. So what you'll see as it's coming through, your Social Security check is getting less and less and less. Then finally, this particular person, 2060, they lose their Social Security check because their IRMAA costs are too high. Their Medicare costs are too high. So every other year in retirement, they are now writing a check to Medicare to cover their Medicare while not getting a Social Security check and getting taxed on that Social Security benefit. So that's what we can see right here in this dashboard.
Is that really, you're really projecting IRMAA to wipe out Social Security benefits for lots of people?
Yeah, so...
Well, let's not say lots of people, but from there, Mark, go ahead.
So we do have a couple examples of people that have received letters from Medicare and Social Security saying you will no longer be getting your Social Security benefit because your Medicare costs are higher than your Social Security benefit. So it's already happening. And starting this month and next month, there's going to be approximately 7 million IRMAA letters going out to Medicare recipients. And those are saying a couple different things. One would be you're now in IRMAA, or they could be saying you're now in IRMAA and you're no longer getting a Social Security check because your Medicare costs are higher than the benefit that you have, the Social Security benefit that you have.
Do you know how many of the 7 million letters are going to say the latter?
Honestly, we have no idea.
No idea, yeah. But you have to worry about this, yeah. Well, it's fascinating. And when you guys refer to IRMAA, are you referring to the Part D premium as well? Because there's no progressive formula there, right?
We refer to both because IRMAA does adhere to both. So there is, if we actually look down here, you have your grid of your income threshold for individual, income threshold for a couple, your Part B and your Part D. And as you go and traverse these thresholds, now you're in IRMAA at the second tier for this particular income threshold. Your Part B goes up from 164 to 230, and your Part D now has a surcharge of 1220 also. So there actually is an IRMAA surtax on top of Part D, depending on, again, it's on top of whatever the premium is, which from whatever state you're in.
So, okay, so if let's say I'm in Tennessee and
Yep.
I'm going to have to pay this, let's say I'm on the third tier, I'm going to have to pay $31.50 a month, no matter whether I live in Tennessee or Kentucky or anywhere, California.
Correct.
It's always $31.50. Plus, I'm going to have to pay the Tennessee premium for the plan I choose, right?
Correct.
Yes.
And if you're married and filing as a couple, each person gets hit with these. It's not one for both people. Each individual gets hit with it.
Got it. Okay. Well, this is yeah. I didn't realize this until now. We have this, Maxify planner tool. We'll have to add this. We have the IRMAA calculated in our tool, but we'll have to add the this Medicare Part D that's kind of independent of anything in that. What does that actually refer to? Is that the Part D IRMAA?
Yeah, that's the IRMAA surcharge, correct?
IRMAA Part D surcharge. That's the actual
Correct,
title.
yeah.
Well, gee, having worked in this area so long and not being aware of this until just now is just telling you how is a statement of either how stupid I am or how complicated the system is.
Complicated,
Or
you're not
it means
stupid.
we spend way too much time on this, Larry.
It's complicated. It is not it's fun to sit and work with people in all walks of life that once they retire, they could be professors in universities that we work with, to engineers, to even, the guy carrying the lunch pail. Once they get here, I don't care what your education is, this is confusing.
So
Well,
let me run down. Oh, go ahead, Larry.
I would just say it's shocking that Social Security and Medicare are not really informing people. The government's not. These are like hidden taxes. We also have the fact that these IRMAA brackets. Let's just go back to the brackets for a second. The brackets are inflation indexed except for the top bracket, right? From what I gather. That's what I've been told.
Yeah, I'm thinking the CPIW. Go ahead.
I'm sorry.
Yeah, the 560 is not 0.5 is not indexed to inflation, from my understanding, which means everybody over time is going to be pushed into the top bracket, which so there's real bracket creep, and that may be also true with respect to the Part D IRMAA provision, that the top bracket's not indexed. Are you guys aware of that the top bracket
So the brackets technically, with the exception of the top tier, is not adjusted for inflation. So when they created the IRMAA brackets, they are supposed to be adjusted based on the CPIU. And then in 2010, there was some legislation passed known as the Affordable Care Act that actually stopped the inflation of the brackets. Then in 2018, legislation started it back up again, starting in, I believe, 2020. So for the last 2 or 3 years, they have been adjusted for inflation. Currently, when you start looking at proposals set forth by Social Security, and anyone can see it, it's look at future provisions for solvency of Social Security. They're talking about not adjusting the brackets ever again.
Okay, but right now the law says that all the brackets are adjusted except the very top, right?
Yes.
So
the first 4 or 5 are the first 4 are adjusted, first 5, then the 6th tier is not. So as you said, there's bracket creep, and it's just a matter of time.
That's the current law. Okay.
Yeah.
The cool. Okay, so show us the rest of what you have here.
So let's see what this scenario does. So basically, we would look at the financial overview. You get a total aggregate of your total income, then your total taxable. So your taxable is the portion of your Social Security tax. The Social Security benefit that's taxed, along with the money you're getting from your 401k. So right now we see year one, 50,000 of the total income. Then only 14,000 of that is taxable. That puts them in the 12% tax bracket. And the amount of taxes federally is $1,600. So again, this 12% is your federal tax bracket only. It's not state. Out of that comes a $9,800 Medicare cost. So the remaining income from your 50,000 is 38,000. We had 84,000 for a target, which means we're down 45,000. But what ends up happening as you traverse down through the retirement, you start hitting your RMDs. And finally, at age 77, this individual is making 103,000 because of RMDs and COLAs. The total taxable is 95,000. We're at our 24% federal tax bracket. The amount of taxes is 22,000. Medicare costs are 22,000 also. The remaining income off that 103 is now 57,000 for a shortfall of 43 over the 100 that we wanted. Here's what happens though. In age 77, we traverse that first income bracket. So we look at that. we're making 99,000, or it's being recognized by Medicare and Social Security. They're in that 24% tax bracket. Your taxes are 23,000, but here's where the problem happens. The year before, you're paying 22,000 in Medicare costs. This year, you're paying 32,000. That's a jump of $10,000 simply because you've traversed a Medicare bracket or an IRMAA bracket.
But Mark, is that assuming that that the brackets are not indexed to inflation, or is that assuming something else?
No, okay. So that's we take the premiums and we inflate them over the years. So now, as you're going down through this, where every year we're checking those brackets to see where do they fall in these brackets, and once they traverse a bracket, we figure out what that particular cost is based on the inflation rate. So right now, we can't say that they're going to go in and change these brackets per year because we don't know what's going to happen. If you look at, I think it was 2007 through 2014, in somewhere in that area, the brackets did not change at all. And then they started changing.
Okay. So this is all
right now it's based on what we know.
Okay, so this is due to bracket creep. You're not keeping 2018 yes. place.
Correct.
Okay.
So
this is kind of the worst case scenario in some ways, right?
This isn't really worst case. I think there's a lot of people that fall within this, but this is worst case. This is the current case scenario of the information that we have. So at 83, go down again. This happens again. So we're making 119,000, 24% federal tax bracket. We have 46,000 in yearly Medicare costs. The next year we hit another bracket. We jump from 46,000 to 69,000. So what that's doing is now reducing your 131,000 of total income down to 32,000 before state taxes. So this Medicare, which is taking up 70,000 of that, is really eating away at these people's retirement. When you get down the end, this person's making 155,000. Medicare's taking 105,000 of that. They're left with $14,000 of overall income from the year. They're still positive, but what ends up happening, and we're going to go over to the Social Security tab, as you can see, once we get down here, at age 84, they're no longer getting a Social Security check, and they're paying $13,000 out of pocket directly to Medicare to pay for those benefits. And that last year, they're now paying $42,000 out of pocket just for the Medicare premiums and surcharges. That doesn't include taxes or anything else.
Are these in real dollars or are these nominal dollars?
Those are real dollars.
Real dollars. So you're taking this scenario that there won't be bracket adjustment, the bracket creep, and that Medicare growth in the premiums, which historically has been super high, will continue, and that this is going to more than wipe out people's Social Security benefits, and they're going to end up having to pay, not just lose their Social Security check, but also pay a significant amount for Medicare. This is quite shocking. I think it's fair to say it's quite shocking. Let's put it that way. I don't want to say it's the worst case scenario. I'm sure it could be even worse, but
the average case scenario, as Mark pointed out, if we take a look at what we already know, we know that Medicare premiums come out of Social Security benefits. We know that Medicare is inflating at roughly 2 to 2.5 times higher than your Social Security benefit, as adjusting for the cost of living adjustment. So for those people that even don't reach Medicare's IRMAA, what's going to happen to their Social Security benefit?
It's still going to be reduced.
It may never be reduced because of what is known as the Hold Harmless Act. Their Social Security benefit will never increase. So as inflation goes up, as we're even seeing this month, inflation rose at 0.5% for the month. As inflation goes up, people on Social Security are losing more and more buying power.
Yeah, the real value, home harmless is where the Medicare premium rises by more than your Social Security benefit.
Bingo.
Due to COLA, and if they would have to cut your Social Security benefit in order to cover the premium difference there, the differential, they don't do it. They just keep it fixed in nominal terms.
Yes.
And then what you're saying is that inflation erodes the real value. So the right. So yeah, this is quite interesting. People can buy this directly, or is it they have to get this through their financial plan?
So before we just jump into that, I just want to show you quickly how this can be solved or mitigated, because this allows you to do that. We look at the financial industry, and we really believe that less than 1% of financial industry knows about this and is planning for it. And this helps. But let's look at a new scenario. So this is something we're going to go back and say, okay, how are we going to fix and help this person out? And sorry, my computer's a little slow here. We're going to use the same information generally. Social Security, we're going to put in a 401k. We're going to look at that. The 401k, we're going to put in 250,000, and we're still going to have a 6% growth rate. But what we're going to do is we're going to move that. Let's say we caught this person early, okay? And instead of having the 750,000 in their 401k, maybe we got it into a Roth. We got it in a Roth IRA. So over the years, they found a way to, pay the taxes, and maybe it's 450,000. They were able to get into that Roth. The rate of return is still going to be 6. Let's say we're going to do 3,000 a month for your withdrawal amount. So all we've done is we've taken some money out of the 401k and we put it into the Roth IRA. Again, this is probably done well before they retire because of some of the rules around Roths. We're still going to have an $8,000, I think we had $7,000 monthly income, 1.5 growth rate. And we're going to do the same thing. We're going to do Part B and Part D. So all we've done, again, is just change some of that income. And once we run this, it's going to run us back and show us the original report, which is Irma has been reached. We have about $1 million in Medicare premiums and surcharges and $513,000 in taxes. Now, again, we've taken that 401k, split it. Now, the person did not reach Irma. They've reduced their Medicare cost by $300,000. They've reduced their federal taxes by, was that $420,000, simply by going to a Roth. If you look at the graphs, total income stays pretty much the same. Total taxable goes up a little bit, but it's $100,000 less at the end. You don't hit any Medicare brackets here, and you save this person's Social Security check. So just by using the correct vehicles, you've saved this person's retirement. You can tell by going down, everything's green here. They have $55,000 left at the end of their retirement. You go to Social Security benefit. They save their Social Security benefit. And if you notice, only 35% of that benefit is ever taxed. Whereas on the previous scenario, you go to Social Security benefit, they're in the 85% tax bracket at 78 all the way through. So just by using different assets like a Roth or life insurance or home equity and just changing the way that the income works in retirement, you can save someone's retirement, you can save someone's Social Security and mitigate those IRMAA charges. So yes, we do have this available to people to use.
Cool. So where do they go and get it, and what does it cost?
So for financial professionals, they can go to Healthcare Retirement Planner. We also strongly suggest going to IRMAA Certified Planner and getting certified. We have every day we have new financial advisors and professionals getting it because you need that information to understand what you're doing. Larry, you've been doing this for how many years? And, there's always still something to learn. And we want to make sure that any professional that's doing it knows what they're talking about. On the software side, it is available at $99 per month.
And there is a coupon for your users as well.
Correct. And also on the client side, so the end user side, the mom and pops that want to try it, we are pushing out the ability for them to run their own report, and it'll send it right to their email for free.
Got it. Now, if you're in Medicare Part C, you're not paying the Part D at all, are you? I mean, isn't that kind of rolled into the Part C, the Advantage plan?
So Part C is known as Medicare Advantage plans. So with
Right.
Medicare Advantage plans, it still doesn't get you out of IRMAA. So if you do reach Medicare's IRMAA, regardless of being in a Part C plan, you are still subject to it. Ultimately, anyone that is enrolled into a prescription drug plan, a PDP, which is a standalone Part D plan, or anybody that's in a Medicare Advantage plan that has drug coverage, they're subject to this. The only way not to be subject to Medicare's IRMAA on the Part D side is to not have prescription drug coverage. That's the only way you can get out of it.
Just saying this, the basic Part D IRMAA, and you're saying that's what it's called, is subject to is independent whether you're in traditional Medicare or the Advantage.
Yeah, regardless if you're in a traditional original Medicare, which is Part A and Part B, or if you're in a Medicare Advantage plan, Part C, you're still subject to IRMAA on both avenues, Part B, Part D. You cannot get away from it. The only way you can get away from IRMAA, technically, is to not have prescription drug coverage. So an example that we give is U.S. veterans. U.S. veterans can pick up their prescription drugs from a credible source, which is the VA. If they can show that they're picking up their medications from the VA, they do not have to enroll into a Part D plan.
Got it. Okay. Well, this is really cool. I want to thank you, Mark and Dan, for conveying this, and invite people to go to the best websites for people to go to are just read it.
It's
shout out
healthcareretirementplanner.com, the one you have on the screen. And the other one is IRMAACertifiedplanner.com, which is the certification page. And from there, anybody that actually is looking for someone who's certified, we have a directory on that site also that allows people to search for a IRMAA certified planner to help them out.
And the certification, what does that run?
The certification is retail $695. So it's a lot less than some of the other ones. You also get 8 hours of CE credits based on the state you're in. And we're looking to roll that out to every state.
And again, there's also for your users, coupon Larry, and there'll be a 20% reduction.
Oh, okay. Use the word Larry. Okay.
Use Larry.
In the checkout. Larry. Okay, great. All right. Well, thank you so much.